Hi everyone, and welcome back to Bowdie Shorts, making law make sense in 15 minutes or less. Today we're looking at one of the most important responsibilities trustees have, investing trust property. So think about your own money. If you had £100,000 sitting in a bank account earning almost nothing, you might decide to invest it. Why? Well, because inflation gradually reduces the purchasing power of money. So you might also want your money to produce an income or increase in value over time. Trustees face exactly the same issues. The difference is that they're investing somebody else's money. So today's question is, how should trustees invest trust property? Now, a trust fund rarely sits still. Trust property might generate income, capital growth, or both. And trustees are expected to ensure that trust funds are properly invested. Leaving substantial sums uninvested for an unreasonable period may itself amount to a breach of trust. And the difficulty is that beneficiaries often want different things. One beneficiary may want income now, another may want long term growth. Trustees must balance these competing interests. So before purchasing any investment, trustees should ask, what is this trust trying to achieve? And the answer varies from trust to trust. Trustees should consider the type of beneficiaries, their ages and circumstances, the size of the trust fund, how long the trust is expected to last, and tax considerations. And the investment strategy should fit exactly to the requirements of that trust. So as an example, suppose property is held for Philip for life, remainder to Rachel. So Philip receives the income while he is alive. Rachel will eventually receive the trust capital, and that creates a challenge. Philip wants income, Rachel wants growth. Trustees therefore need an investment strategy that balances both interests. Now, thinking about risk for a second, the length of the trust is often important. Generally speaking, the longer the investment period, the more risk trustees can tolerate. Why? Well, because any short term losses may be recovered over the time of the trust itself. But as beneficiaries move closer to becoming entitled to trust property, trustees will often start to reduce risk and protect capital. Let's have a look now at diversification. You've probably heard the expression, don't put all of your eggs in one basket, and trust law agrees. Trustees should usually spread investments across different assets, and this is called diversification. The aim is simple. If one investment performs badly, other investments may offset the loss. Now we've talked here a lot about the rationale for investment. Let's now look at some common types of investment before we then look at the legal rules that underpin them. So shares are a good type of investment. They offer two possible returns. They offer income through dividends, and they offer capital growth if the value of the share increases. Now, shares often perform well over long periods, but can be volatile in the short term. So different sectors and geographical markets would carry different levels of risks when it comes to purchasing shares. Bonds are essentially loans made to governments or companies. In return, the investor receives interest. And bonds are often viewed as income producing investments, and they tend to be regarded as relatively low risk. Property can provide rental income and capital growth, and property has traditionally been viewed as a relatively stable investment, although values can rise and fall. Cash can be held in bank accounts because it provides security, liquidity, and usually some interest. However, cash rarely delivers significant capital growth, and as a result, it is often only one part of a balanced portfolio. So what's not an investment? Well, some things are not investments at all. Examples would include gambling, speculative betting or buying ordinary assets that simply depreciate. Trustees are expected to make genuine investment decisions, not to take reckless buying decisions. Now, when it comes to choosing these things, it's always important to note that express terms will come first. So trustees should begin by looking at the trust instrument, as the settlor may have specified permitted investments, prohibited investments, ethical restrictions, and any special powers. And those provisions take priority. If there's no relevant provision, then we have to turn to statute. The statute that we look at here is the Trustee Act 2000 and what's known as the General Power of Investment. Now, trustees enjoy extremely broad investment powers, with the general principle being that trustees can make any investment that they could make if they owned the property themselves. And this gives them this huge amount of flexibility. But there is one important distinction. Special rules apply to land. So trustees may acquire land in the UK as an investment, or for occupation by a beneficiary, or for another trust-related purpose. However, the statutory power only applies to land in the United Kingdom. So suppose trustees purchase a cottage in Cornwall for a beneficiary, that falls within their powers. But if trustees purchase a villa in Spain under the statutory investment power, they'll be acting outside their authority. Now, whenever trustees buy or review investments, they must consider two key factors known as the standard investment criteria. First, suitability. So the proposed investment must be suitable, and trustees should ask two questions. Is this type of investment appropriate? And is this particular investment appropriate? So suppose trustees decide that shares are suitable. That's only one step. They must then decide whether a particular company represents a suitable investment. Not all shares are equally valued. Secondly, diversification. Trustees must also consider whether the investment portfolio is sufficiently diversified. So a large trust fund invested entirely in one sector creates an unnecessary risk. The greater the trust fund, the easier it usually becomes to diversify. So suppose trustees are investing £700,000 in 3 oil companies. Even though there are 3 investments, they all depend on the same sector, and this may not provide adequate diversification. A downturn affecting oil or gas could damage the entire portfolio. Reviewing investments is important to look at, because trustees cannot simply buy investments and forget about them. Investments must be reviewed from time to time, and the frequency depends on the circumstances. A stable trust may only require periodic reviews, but if market conditions change dramatically, trustees may need to review much sooner than they planned. Now, one of the most important examination points to consider is that trustees should normally obtain proper investment advice, unless there is a good reason not to do so. The advice should come from somebody reasonably believed to be qualified. But the advisor who the trustees go to is not the person who makes the decision. This is crucial. Professional advisors advise, trustees decide, and the ultimate responsibility remains with the trustees. Now, when exercising investment powers, trustees must exercise such care and skill as is reasonable in the circumstances, with professional trustees held to a higher standard than non-professional trustees. So a solicitor acting as trustee will be expected to demonstrate greater expertise than someone with no specialist knowledge. But trustees must also remain impartial, and this is particularly important where beneficiaries have different interests. So imagine a situation where we have a life tenant and a remainder beneficiary. The life tenant will want income. The remainder beneficiary wants capital growth. The trustee's job is to strike a fair balance between them. They cannot simply favour one beneficiary and ignore the other. Now, trustees are expected to seek the best financial return for beneficiaries, but that does not mean the highest possible return, because the highest return often involves excessive risk. Instead, trustees should seek the best return that is consistent with sensible risk management. Now, can trustees take ethical considerations into account? The answer is sometimes. For example, where returns are broadly equivalent, or where the trust is charitable, or where the trust instrument directs trustees to avoid particular sectors. But financial considerations will still usually take priority. Let's now quickly look at delegation. Now, many trustees do not feel qualified to manage investments personally. Fortunately, the law allows investment functions to be delegated. Trustees can appoint an investment manager or financial advisor to manage investments on behalf of the trust. So how does delegation work? Well, the delegation must be formalized. So trustees must appoint the agent in writing. They must produce a written policy statement. They must ensure the agent follows that policy, and they must review the arrangement regularly. Over and above everything else, they must select a suitably qualified person. Now, we mentioned a policy statement there. Policy statement simply explains what the trust is trying to achieve. It should identify the needs of the beneficiaries and the objectives of the trust, and the investment manager then uses that guidance when making decisions. Now, are trustees still liable? Generally speaking, trustees are not liable for the agent's investment decisions, provided that the agent was properly selected, the correct procedures were followed, and the trustees performed their own supervisory duties. However, trustees remain responsible for failures in that appointment and monitoring process. So suppose trustees hand a £2 million trust fund to a friend with no relevant qualifications and never review what he's doing. If losses occur, the trustees may find themselves liable because they fail to exercise proper care when selecting and supervising the agent. So let's bring this all together. Whenever trustees think about investments, they should ask, what are the objectives of the trust? Is the investment suitable? Is the portfolio diversified? And have we taken proper advice? Are we acting fairly between beneficiaries? And have we reviewed the investments recently? If trustees can answer these questions properly, they're usually on the right track. Now, what's Bowdie's bottom line here? Well, trustees have extensive powers to invest trust property, but those powers come with responsibilities. Remember that trustees can generally make any investment that they could make personally. Investments must be suitable. Portfolios should be diversified, and professional advice should normally be obtained. Trustees must review investments regularly, and trustees must balance the interests of all beneficiaries. Investment functions can be delegated, but responsibility for the process cannot. Because at the heart of this video is one simple question: how can trustees grow and protect trust property for the benefit of everybody involved? And that's exactly what trust investment law is designed to achieve. Thank you very much for watching this video in the Bowdie short series. There'll be further videos available via our YouTube channel. Look out for our series on contract law and tort law, as well as our trust content as well.